Welcome back to the channel. A lot to unpack, a lot to talk about this week, especially now with the CPI data coming out ahead of the next Bank of Canada meeting, which is set for July 30th. Ultimately, with this data, what does it mean for the Bank of Canada? Are we going to see the Bank of Canada cut at the end of this month? Or we're going to have to wait for better odds come September? Want to share our thoughts and opinions this week. Once again, welcome back to the channel. If you have not yet subscribed, please consider subscribing. Hit that notification bell so you can stay up to date with everything happening in the mortgage and real estate marketplace, as well as I want to hear from you, our viewers and clients, in the comments section below. Let us know your thoughts on what you think the Bank of Canada is going to do next. And don't forget to like and share the video. But right now, let's get into it. So ultimately, this week, we got those CPI headline inflation numbers coming in a little hotter at 1.9%, obviously up from 1.7%, ultimately still below the 2% bandwidth that Bank of Canada wants, that 1 to 3%. That's what they're aiming for. And ultimately right now, that is still below. But the bigger picture right now is what's happening with core, medium, and trim, the numbers that the Bank of Canada pay super close attention to when making their policy rate decisions. That policy rate decision is coming up at the end of the month. And ultimately with medium and core ticking up slightly, and basically trim staying put, it's obviously not moving in the right direction. It is something that the Bank of Canada is going to be very conscientious of, especially with all the uncertainty that still continues to linger in the Canadian economy when it comes to those Liberation Day tariffs. Obviously, with what's happening in the United States, that is still a big weight in on the Canadian economy. And also with the fact that the unemployment rate ticked down slightly. I mean, nothing to call home about here, but ultimately still hovering in that 7% range. As we discussed last week, with all the job losses and Ontario and other provinces feeling, some other provinces feeling those pressures in specific regions, much higher than that 7% mark. What is it going to do for the Bank of Canada? Now, ultimately, based on the current data sets that we see right now, it does look like, at least in my opinion, and for many economists, many analysts, that the Bank of Canada is going to continue to hold that pause button, as they do have the cover to hit the pause again. Now, what that means is that if you have variable rate mortgage, you're probably not going to see anything changing anytime soon. I know there's a lot of people that we talked to that were at the beginning of the year looking at the Bank of Canada when they were starting to continue their cuts, but now we've paused several times, and I think we're going to see another pause on July 30th. Let me know what you think in the comments section. Now, ultimately, what does that mean for fixed rate mortgages, variable rate mortgages? Variable rate mortgages, just as a quick refresher, if you're new to the channel, make sure you're subscribed. But ultimately, variable rate mortgages move with the Bank of Canada and their policy rate decisions, which impact their lenders, the banks, their prime lending rate. That ultimately determines how your payments or principal interest calculations get determined. Now, ultimately, that does not move fixed rate mortgages. Fixed rate mortgages move on a different barometer. And as we've discussed at great length on the channel, that moves on obviously bond yields and the inverse relationship between Canada bonds, obviously what's happening in the US. So we definitely have seen some upwards pressure on those Canadian bond yields, which means that if we continue to see this resistance, from them coming down and continue to spike upwards, the banks may alter their rates in the coming weeks and months ahead. Ultimately, as global pressures from both Japan and US continue to weigh in on those 10-year treasuries, this continues to be the major conversation. So once again, as we've talked about at great length, we want to find out what's happening with fixed rate mortgages. Just look to our partners to the south and look at their economy, look at their treasuries, and we'll sort of get an understanding of what things happening there. And that has a lot to do with, what is going to happen here in Canada. Remember, when the US sneezes, Canada and the world catches the cold or the sniffles. So we have to really pay close attention to that. And ultimately right now, as we continue to see not so much stellar news in the housing market, obviously fixed rate mortgages, millions of Canadians renewing, we're facing a lot of challenges. The biggest thing that we're finding right now, and this is sort of a conversation for our clients, those who are looking to renew, refinance, restructure, even if you're not a client, you're looking to be, maybe want to become a client of InTouch Mortgage Solutions, feel free to reach out. But more importantly is the valuations on those properties, especially if you're looking to consolidate, if you're looking to pull out some of that equity to maybe pay out those lines of credits. Ultimately, a lot of situations right now, And if we continue to see this weakness in the housing market, obviously prices continue to fall. That does impact the equity for homeowners. And ultimately, that does open up a door for home buyers, as we are definitely in a buyer's market right now for those that are looking to enter the market, not rushing anybody into any decisions, but ultimately to keep an eye open on the market. A lot of clients that have been eyeing some homes in specific pockets are starting to see some come to the forefront and looking to put in offers. Obviously, time is the best option. It is the best friend that you have when looking at these properties, but a lot of them are getting pre-approved. So if you have not been pre-approved and considering that fixed rate mortgages potentially could be moving up in the next few weeks, if we see that persistence in the bond market, you may want to get a pre-approval if you're thinking about getting into the market to buy a home. At least lock in a rate for 120 days. Doesn't really cost you anything to do that, and you do have a little bit of a security blanket in the event that rates go up. Obviously, if rates go down and you have an existing pre-approval, whether it be with us or a different broker or bank, you should be fighting for that lower rate, because if the rates do end up going down, just because it's one rate on your pre-approval doesn't necessarily mean that that's the end result, at the end rate. And if you want a second opinion, always feel free to reach out to us here at InTouch Mortgage Solutions. We're more than happy to help. But we'll leave the video here. Just remember, subscribe to the channel, stay up to date with everything that's happening. We will be covering the Bank of Canada rate announcement on July 30th, of course, what it means for the Canadians, what it means for Canadians with mortgages. So don't forget to subscribe, but we'll see you all next week. Thanks again for stopping by. Have a great one.